Hi, this is Barack Sam. Welcome to this episode of the Working Abroad show. We're looking forward to the budget next year for November 25, and we're looking forward to what tax creep will occur on inheritance tax today. We discussed over the last few weeks, and you can see on the Living Working Abroad show the various scenarios that could happen to your property, to your wealth, to your income in the coming years. So for expats or people that are investing or got an income arising out of the UK, it's time to review it and change. If you need to review, you can contact us at productpartnership.com. We offer a new free review to any new client inquiries, and to do that. And watch out for our reaction living and working abroad podcast next week, where we'll be commentating in real time on some of the issues that are coming up. Better perspective will come out in the following few days vis-a-vis the aspects that are going to affect expats and investors with income, property or investment or pension assets in the UK. So let's have a look a bit more and do a general summary of how things are going to be impacted by the changes, what they could be, and how they're going to affect, and what the changes that you can make anyway. And some of the changes that we're talking about here, you can do anyway, even now. Some of them might be stopped going forward. Some of them might become more urgent because the tax penalty for taking no action could go up. So let's have a look at that. So we'll talk about the potential wealth tax being introduced, whether they call it a mansion tax or a revision of council tax, whatever. If you've got assets in property, investments, um, or any other form of valuable asset in the UK, which is not producing income and it's not producing capital gains tax revenue for the government until you sell it, they could decide just to tax it just because you're wealthy and you own these assets. You might have saved, you might have invested, you might have inherited and paid tax, but now the fact that you've got that wealth is a source of tax for a tax charging government. A wealth tax would work on any asset value that you've got. Now, they'll pick a figure to go above, so they might not tax a wealth tax below 1 million or below 500,000. We'll wait and see. At the moment, if you've got an estate of more than £325,000 when you die, you're deemed wealthy and you start paying inheritance tax. So that's the base assumption for potentially for a wealth tax, which might just be a roll-up tax that you then pay when you sell that asset. So when you buy a property, you pay stamp duty to buy the property. It could be that everything is simplified and you pay an exit tax when you sell and dispose that asset based upon how many years you've owned it, and that charge rolling up. So that's one potential option that we've got there. What we do know with a fair degree of certainty um, is the current government will keep changing their position and they'll do or say whatever they need to say to get re-elected or to appear good to the people that they're serving. And we know that democracy is always swung back to the centre, so the far left policies of the current government will come back to the centre, either internally within the Labour Party or to the next election. But what they've deemed people that shouldn't pay any more tax is working people earning under £45,000. Now, if you've got income coming out of the UK under £45,000, you need to be aware of the significance of that. You're a 20% taxpayer. So if your income is in the higher rate bands, then you could be potentially likely to be paying more tax. One way they could do it is to simplify the tax system. What type of simplifications they can do? We can see three potential ways they could simplify tax. Between 100 and 125,000 is a complete and utter mess because you gradually move from 40 to 45% tax. Whoever introduced that nonsense just decided to complicate everybody's life. it's an easy win for a tax raising government to say no, forget the graduation, 45% tax starts at £100,000 instead of 125,000, and then you haven't got any complicated tax calculations beyond that. However, if you earn over £50,000 a year, you're into um, a basic high rate tax. You can move from basic rate to high rate tax. So the basic rate tax band is about 37,000. You've got a personal allowance of just under 13,000. So once you get over 50,000, you're paying high rate tax. So why not simplify it even more for those wealthy people earning more than 50,000 a year, and make to get rid of the extra 100 to 125 band and make everybody over 50,000 paying 45% tax. That would simplify it. Then left with two income tax rates, 40 and 45%, which would generate and raise additional tax revenue for the government without taxing working people. By consolidating those two rates. Another potential radical simplification approach that they could do is to say, we're going to scrap the capital gains tax rates. Now, as we know, in the last budget, they put up capital gains tax rates by 80%, from 10 to 18%. So now you've got two rates of capital gains tax, um, basic and high rate, 18 and 24%. So why not simplify capital gains tax? Why not make it payable at the income tax rate, which could be 20 and 40%, or 45% if the higher rate band is changed to that. So that could be a lot of simplification of the UK tax system on income. It could be simplified right down to two rates, 20 and 45%, or 20 and 40%. For all people, but only wealthy people earning more than £50,000 getting the extra tax burden on that. But you could more than potentially double the rate of capital gains tax for high rate payers. So they increased it from 10 to 18% at basic rate in the last budget, but they didn't change the upper rate, 24%. So if they change that to 40%, the same rate as inheritance tax and high rate tax, that would be an alignment that they could do as well. So look out for that. The big changes could come in inheritance tax. Again, with an aging population, with the cost of care home facilities and benefits going up, the government needs to be raising tax in the short and in the long term. Inheritance taxes is a new way. When you die, we tax your estate. So you tax on the income that you earn, you tax on the wealth that you build up, you taxed on the interest and the dividends that you make, and then on top of that, you taxed on the when you die again on the estate value. At the moment, it's a 40%, but the personal allowance has been pegged for a long, long time. So the personal allowance is 325,000. Now in the UK, the average residential property value is £275,000 at the end of 2025. So the average residential property is using up your nil rate band in the UK, or it's more than using up your additional personal allowance for inheritance tax when you die. Now, given that they've added pensions into inheritance tax as well, that muddies the water a bit more. If you've got £1 million pension fund at the current annuity rates, then you generate an income of 45,000 a year. Oh, from working people. Working people earn only up to £45,000 a year in the UK. So your £1 million pension fund is necessary to earn you a working, livable income in the UK. But it also goes towards inheritance tax. So when you die, potentially 40% of that is taxable. But of course, now that the pension is being added into the inheritance tax pot, there's more liability building up. But what about if they start tampering with the personal allowances? So in inheritance tax, they've had a fixed rate personal allowance for inheritance tax for a long time at 325. 10 years ago, they added in an additional 175,000 as a personal allowance if you've got your main residential property that you're selling. But what if they decide to remove that because that's just for wealthy people? So they could readjust it in one of two ways. They could abolish the additional complication of the additional relief of the 175 owning a main property in the UK, and take it down to 325. Or you could say, oh, instead of the complicated two rates, we'll just make one rate. Let's say they make the personal allowance for inheritance tax, they increase it up to 400, say. It's actually less, 100,000 less than you can get if you've got a residential property. It's more if you have got that residential property. But either way, that means that you could potentially lose or pay an extra 40, 50, 60,000 inheritance tax if they messed around with the personal allowances to reduce them. Even so, your pension fund is going to use that up anyway. So if you've got a £1 million pension fund and a £275,000 property, or let's call it 325,000 property, you've got £1 million now that is subject to inheritance tax. So before the last Halloween budget in November 24, £275,000 property would use your inheritance tax personal allowance, and there's no inheritance tax on first death. Now, with your £1 million pension to pay your working income of 45,000 plus your average property value, it uses your personal allowance and means you've got 400,000 of inheritance tax to pay. And that is the scenario that we've already got before they start increasing or changing or adjusting any of the tax liabilities that they've got. What can you do about inheritance tax? You could live forever, or you can do something about it. One of the things you can do is you can give it away. Now, at the moment, you can give things away, or you can, if you're an expat, you can sell and avoid capital gains tax assessment to the UK. But that's under the current rules. If they don't change those options and they don't stop you giving to your family without an inheritance tax liability, then the potential that you could do that. Now, what are the solutions that Proact offer? Looking at it from a Cyprus perspective, if an individual UK citizen becomes an expat in Cyprus and potentially non-domicile expat in Cyprus after 10 or 20 years, then there's a number of things that they can do. If a British person relocates to Cyprus, apart from having an English-based culture, Greek and English, a strong expat community, an international, dynamic, pro-business economy, environment and government, you've got 0% tax on capital gains tax, you've got 0% tax on inheritance tax, you've got 0% on dividend tax, you've got 0% on interest tax. So all your savings, all your interest, your property, your investments, and your inheritance you want to leave to your children is 0 tax. You might pay an income tax up to 35%. You might pay what they call a health tax, which is a wealth tax of 2.6%. But that is it. It is a low tax European economy with a strong English, British connection. Yes, you can go to Dubai. That's a different culture that works as well, and there are other places around the world. But for Cyprus, it can work very well to have an EU base, but a European base with a strong a British connection, and you can pay 0% on inheritance tax, dividends, capital gains, and interest. It goes further. If you've got £1 million pension and you're a self-invested pension and you're a tax resident in Cyprus, you can draw pension income at 5%. Now, the funny thing is, there's no limit on the amount you can draw. So if you draw £1 million income in the first year of your retirement in Cyprus, you pay 5% tax. In the UK, you can pay 45% tax. In Cyprus, you pay 5% tax. But if you draw that income out, A, it's free of the constraints of a pension fund. B, is free of automatic inheritance tax assessment on first death. So C, you can give it away or invest it separately um, from your children. And therefore, it, an individual British expat with a UK pension fund can draw it out and pay a maximum 5% tax if you take action on that. You can also gift to trusts. Now, they're trying to tighten up the rules on trusts in the UK. In Cyprus, English law, trusts work, and trusts not only do they have no inheritance tax, zero capital gains tax, no dividend tax, no interest tax on overseas income and profits, but if you gift the assets into a family trust for your business or your property or investments, then you're gifting them away and you're removing the requirement to complete an inheritance tax return on death. Now, that's not absolutely true in every case. You need to review it carefully and plan for it carefully. But depending upon what you do over a 20-year period or 10-year period or less, you can become non-domicile and avoid the liability to inheritance tax as well. So there's lots to talk about if you've got assets. There's a budget that's coming up next week. Watch us live on the Living and Working Abroad show to see how it's going to affect you. And contact us at productpartnership.com for a full review and advice on living and working abroad to hold assets in a family trust or a business trust or live and work abroad and pay 0% tax, however you want to be paid as a contractor, dividends, interest on business loans, or 0% inheritance tax. Thanks a lot for listening, and we'll see you next time.